You have $10,000 in your bank account right now, and before you do anything with it, anything at all, you need to understand something. That $10,000 is a live grenade. In the hands of someone without structure, it detonates slowly and silently. One emotional decision, one market headline, one can't-miss tip from a friend, and the money doesn't explode dramatically. It just evaporates, transferred quietly into the pockets of people who knew exactly what they were doing. I've seen it happen to smart people, educated people, careful people. They weren't careless. They were uninformed. But deployed correctly, with discipline and precision, that same $10,000 becomes a seed that compounds while you sleep. And that difference is not luck. It's process. I'm James Harrington. I've built companies, managed capital through crashes, bull markets, rate hikes, and pandemics. And if I had to start over with $10,000 in 2026, this is exactly how I would deploy it. Before we talk about strategy, let's talk about mistakes. The first mistake is going all in on one idea, one stock, one crypto, one sector. That is not investing, that is gambling. Even the best ideas fail. Markets shift. Industries rotate. When you put everything into one position, you have one soldier in battle. That's not an army. That's a target. Diversification isn't exciting, but it's survival. No single position should ever exceed 30% of your capital. That rule alone protects your future. The second mistake is chasing yesterday's winners. When an asset has already doubled and everyone is talking about it, you are late. By the time financial media screams about a trend, the easy money is gone. I am not a momentum chaser. I look for sustainable yield and real cash flow, not hype cycles. If you've heard about an investment everywhere in the last 30 days, that's not a buy signal. It's a warning sign. The third mistake is confusing speculation with investing. Investing means buying assets that generate real cash flow, dividends, interest, earnings growth. Speculation is buying something only because you hope someone else will pay more later. That's hot potato. Serious money belongs in assets that pay you while you sleep. If you must speculate, cap it at 5%. The rest belongs in structured, income-producing investments. The fourth mistake is ignoring cash flow. Most people obsess over price appreciation. That's hope-based investing. Real strategy focuses on income. Dividends and interest provide proof of profitability. They reduce stress during downturns. They fuel compounding. Cash flow is not optional. It is the engine of wealth. The fifth mistake is paralysis, waiting for the perfect moment. Perfect conditions never arrive. There will always be uncertainty. Time in the market beats timing the market. Waiting costs you compounding, and compounding lost is permanent. Now let's build the framework. Pillar 1 is your foundation, 40% into broad market ETFs. The S&P 500 for core U.S. exposure and an international developed markets ETF for geographic diversification. Low cost, broad exposure, no single company risk. This is your bedrock. Pillar 2 is your cash flow engine, 30% into dividend growth ETFs and monthly income vehicles. Assets that generate consistent yield and grow that yield over time. Income that compounds automatically. Pillar 3 is your defensive bulwark, 15% in short to intermediate term U.S. Treasuries. Stability, balance, capital preservation during volatility. Pillar 4 is your strategic opportunity sleeve, 10% allocated to a researched, thesis-driven theme. Not speculation. A focused bet with strict limits. Pillar 5 is dry powder, 5% cash. Opportunity capital. When markets pull back, you deploy. You buy quality at a discount. The structure is simple. 40% foundation, 30% income, 15% defense, 10% strategy, 5% cash, and the rules are non-negotiable. Diversify, avoid hype, separate speculation, demand cash flow, execute without waiting for perfection. This is James Harrington. Money doesn't sleep. Make sure yours is working harder than you are.